Hello everyone. Today we're going to talk about Chapter 13, Return, Risk, and Security Market Line. We're going to talk about returns, expected returns, variance, portfolio risk, portfolio expected return, and diversification. Later on, we will talk about market portfolio, market equilibrium, and the famous CAPM model. So first of all, let's talk about individual securities return. Well, when we calculate the expected returns, we have to calculate the returns in each one of the different stages. And then we have to calculate the expected probability-weighted average return across different stages. The variance, or the volatility of the stocks, is going to be the probability-weighted average of the distance of each return observation to the mean return. I'm going to use the following table to illustrate how we calculate expected return and the stock variance. So we're going to use this table for the next couple of slides. Okay. Now we have a stock and a bond fund. You can think about the stock funds and the bond funds as one individual stock and one individual bonds. Alright, so now we have one stock and one bond. To calculate the returns for the stocks and the bonds, what we have to do is we have to calculate the different scenario returns. Like for example, we have three different scenarios: recession, normal economy, booming economy, each with 1/3 of the probability. In the recession, the stock will have 7% loss. Bond will yield 17% return. In a normal economy, stocks will have a higher return, 12% versus 7% return for the bond. In a booming economy, stocks will yield 28% return, while the bond will lose 3% return. So that is the setup of the question. Okay. Alright, so first of all, let's calculate the expected return for the stock. In recession, the stock return is 7% loss, 1/3 of the probability for recession. In a normal economy, the stock return is 12%. Again, 1/3 probability for the normal economy. In the booming economy, the stock return is 28%. Again, we have 1/3 opportunity to be in the booming economy. So if you add them up, the probability-weighted average return is 11% for the stock fund. So we put the expected return 11% right here. Similarly, you can calculate the expected return of 7% for the bond funds. Okay, after we calculate the expected returns, we have to calculate the variance and standard deviation. So the first step is we're going to calculate the squared deviation, or the distance from each return to the mean return. In the previous slides, we calculated the expected return for stocks, 11%. Okay, so for this return observation, minus 7% in recession, minus 11% expected return squared. Because we're thinking about the distance, we want a positive number. The squared deviation is 0.0324. Similarly, we calculate the squared deviation for the normal and the booming economy. Alright. To calculate the variance, again, we plug in all the numbers in our formula. We calculate the probability-weighted average of all the squared deviation. So the total variance is 0.0205 using this formula. Standard deviation is the square root of the variance, which is 14.3%. In this lecture, we are going to use standard deviation as the measure of the risk. Similarly, you can calculate the standard deviation for the bond as well. Okay, So the next concept I want to introduce is called portfolios. So what is a portfolio? A portfolio is a collection of assets. For example, S&P 500 is a portfolio. S&P 500 is a portfolio of 500 stocks. So it's a collection of 500 biggest stocks in the US market. So an asset's risk and return are very important in how they affect the risk and return of the portfolio. For example, if the portfolio consists of high risk but high return stocks, overall the portfolio will have a higher risk and higher return. The risk-return trade-off for a portfolio is measured by the portfolio expected return and standard deviation, just as with the individual assets. Okay, so let's take a look. Now let's form a portfolio of stock and bond fund together. So when you form a portfolio means you are going to invest in both stock and bond funds. Then you're going to have a portfolio weight on the stock and the bond. In this example, let's say if you want to put 50% of your money in the stock and another 50% of your money in the bond portfolio, let's see what happens to the portfolio returns. To formally introduce the idea of portfolio weights, in our previous example is 50% for stock and 50% for the bond. Let me introduce the formal definition. We can describe the portfolio by the portfolio weights, which is the fraction of the total investment in the portfolio in each individual investment in the portfolio. So the weight right here, WI, is the weight for individual stock I, which is calculated as a fraction of the total market capitalization of investment I divided by the total value of the portfolio. What does that mean? Think about the portfolio is S&P 500. Means the total value of the portfolio is going to be the total market size of all 500 stocks. The weight for stock Google is going to be the total market size of Google divided by the total value of the 500 biggest stocks in the US. The portfolio weights must add up to 100%. Means if you have N stocks in your portfolio, the weight for stock 1 plus the stock 2 plus until stock N, the weight will be 100%. The return on the portfolio is going to be the weighted return of all individual assets in the portfolio. So we're going to use P to represent portfolio return. So the return for the portfolio is going to be the weighted average of all individual stocks. So the weight for stock 1 times return for stock 1 plus the weight for stock 2 times the return for stock 2 until the last stock weight times the last stock return. Okay, so let's calculate our portfolio return. If we invest 50% in stock and 50% in bond, what is this portfolio's average return? Alright, so let's plug in the numbers here. The portfolio return will be 50% weight of the stocks in the recession, which is 7% loss, plus 50% chance of 17% from the bond. So the portfolio return in the recession is going to be 5%. Similarly, we can calculate the portfolio return for the normal and booming economy. The expected return of the portfolio. Most of the time, we do not know each individual stock's return. The returns are all expected numbers. So here I changed the previous formula a little bit. I add a expectation sign in front of each return. Okay, so the expected return for the portfolio is going to be the average of the recession, normal, and booming economy, which is, again, probability-weighted average of these three numbers. Or we can use the portfolio return formula. So the expected return for the stock is 11%. Expected return for the bond is 7%. And we put 50% in stock and 50% in bond. So the weighted average return is 9%, which is exactly the same when you calculate the probability weighted average of these three numbers. So here you have two ways to calculate expected returns. The first one is using this formula. We're using the expected return for stock and expected return for bond, 50% in each investment. You get 9% expected return for the portfolio. The second way to get this number is the probability weighted average across three different scenarios. You're going to have exactly the same number. Okay, now we have to calculate the portfolio's risk, which is measured by the variance and standard deviation. I know the formula here could be very difficult and complicated to remember, but still I would expect you to remember the formulas during the exams, at least for the two assets scenario. Now, how to calculate the variance for the portfolio of two stocks? So the variance of the portfolio of two stocks or two risky assets will have three terms in the formula. The first one is the weight for the first stock and the variance of the first stock. The weight for the second stock and the variance of the second stock, plus the covariance of the stock 1 and stock 2. Portfolio risk. Here we're going to use this formula to calculate the portfolio variance. So rho BS is the correlation between the stock and the bond funds. As we showed before, the correlation is negative because whenever the stock return is high, the bond return is low. So in our case, we're going to use minus 0.99 as the correlation between the two. Then we just need to plug in all the numbers. So the variance of the portfolio is going to be 50% bond times standard deviation of the bond squared plus 50% in stock times standard deviation of the stock squared plus 2 times 50% times standard deviation of the bond times 50% stock times standard deviation of the stocks times correlation of the bond and the stock. So the final number is 0.00110. Standard deviation is the square root of the variance. Okay, so now let's take a look at the portfolio standard deviation, which is the measure of the total risk. Standard deviation for the stock fund, 14%. Standard deviation for the bond fund, 8%. While the combined stock and bond portfolio standard deviation is only 3%. So that is the diversification benefits, because if you put your money in the stock, you're going to suffer the loss in recession. If you put your investment all in the bond, you're going to suffer loss in the booming economy. But when you combine the two, the average, you're never going to have any loss at all. So that is why the risk of the total portfolio is actually lower than just investing in a stock or in the bond. That is the benefits of the diversification. So what is diversification? Diversification means you need to make investment in several different assets across different sectors, industries, or even countries. So diversification is not just holding a lot of assets. For example, if you hold 50 internet stocks, you're not really diversified, because if something happens to that industry, the total return is going to be ruined, just like the 2001 the IT bubble, the internet bubble. However, if you invest 50 stocks in 20 different industries, then you can consider that is a very diversified portfolio. So diversification can reduce the total variance or the total risk of the portfolio without sacrificing the returns, which is shown in our previous numeric example. But why? The reason is the reduction in the risk arises because worse than expected returns from one asset are offset by better than expected returns from another. In our previous example, the negative return of the stock is compensated or offset by the higher return of the bond. The negative return of the bond is offset by higher than expected return from the stocks. So that is why your total risk is reduced. But diversification can only reduce risk to a minimum level. You can never diversify away all risk. So let's take a look at the components of the risk. The red one is the portfolio risk. Okay, so on the vertical line, we have the standard deviation, which is the measure of the risk. On the horizontal line, we have the number of assets in the portfolio. When you just hold one stock, your total portfolio risk is very high. If something happens to that asset, for example, stock, you're going to lose a lot of money. But when you increase the number of assets, say 2, now you have both bond and stock in your portfolio, your total risk will be reduced. The reduced portion is called diversifiable risk, or non-systematic risk, or form-specific risk, or unique risk. So those 4 terms can be used interchangeably. But something you can never diversify away is the risk that is market risk, systematic risk, or non-diversifiable risk. So the systematic risk, the portion that can never be diversified away, is the risk factor that affects a large number of assets. For example, inflation. It doesn't really matter how many stocks you hold. If there is inflation risk, you're going to face it anyway. Interest risk, GDP change. Those are more risk factor to all the economy, all the stocks. So no matter how many stocks you hold, you're going to face the same level of risk. The second type of risk is the unsystematic or form-specific risk. That is the portion of the risk can be reduced by holding a lot of assets in your portfolio. For example, labor strike in one company, part shortage in another company. But if you hold 500 different stocks, 500 companies all have the labor strikes, that probability is really low. So don't really have to worry about that specific risk. If you hold enough number of stocks, the form-specific risk can be diversified away. So the total risk is going to be the systematic risk plus unsystematic risk. So go back to the picture we had before. Systematic risk, no matter what, you cannot diversify it away. Form-specific risk or unsystematic risk can be diversified to 0, almost 0, when you hold a large number of stocks. So eventually, the portfolio risk will be just a systematic risk. For a well-diversified portfolio, you shouldn't worry about form-specific risk at all. All you need to worry is the systematic risk. So the standard deviation of the returns is a measure of the total risk. Well, for the well-diversified portfolio, we don't really have to worry form-specific or unsystematic risk because they are diversified away approaching to zero. So the total risk for a diversified portfolio is just systematic risk. So standard deviation is not a good measure of risk for well-diversified portfolio. There is a reward for bearing risk. There is not a reward for bearing risk unnecessary. Means if you bear systematic risk, yes, there will be reward return to that. But if you did not diversify your portfolio, you only hold one stock in your portfolio, you are facing unnecessary firm-specific risk. There will be no reward for that. So the expected return on a risky asset depends only on that asset's systematic risk, because unsystematic risk can be diversified away. So that is the basic systematic risk principle tells us. So the market portfolio is a portfolio of all assets in the economy. Think about S&P 500 as the example of the market portfolio. It holds 500 biggest stocks in the US market. So the weight for each stock in the S&P 500 is according to the company's size. Facebook, Google, Amazon, Microsoft are the largest companies in the S&P 500. So their weight in the S&P 500 market portfolio are going to be higher than other smaller companies. Okay, in the previous slides we said standard deviation is not a good measure of the portfolio risk, especially for the market portfolio or any well-diversified portfolio. We're going to need a risk measure that measures only the systematic risk, which is beta. So beta is defined as the covariance of any single stock with the market return, divided by the market risk or the market variance. So basically, beta measures the responsiveness of a security to the movements in the market portfolio. So one is the cutoff value. The portfolio beta for the market portfolio is 1. So the market portfolio beta is 1. But some companies have higher than 1 beta, and some companies have lower than 1 beta. What does that mean? Beta equals 1 means that asset has the same systematic risk as the overall market. If beta is less than 1, means the asset has less systematic risk than the overall market. If beta is greater than 1, then the asset has more systematic risk than the overall market. Here are some selected betas. Okay, so when you look at the company's beta, one thing you want to keep in mind is that number is changing all the time, because beta is the calculation of covariance divided by the variance. So the variance and the covariance numbers are going to be changing all the time depending on the stock price changes. For example, Johnson & Johnson, the reported beta is 0.67, which is less than 1, means the systematic risk for Johnson & Johnson is lower than the market. Of course, because Johnson & Johnson sells some essential daily products, so no matter what is the market condition, you're still going to use them, so the market risk is relatively lower. Apple, on the other hand, has a beta higher than 1, means Apple is bearing a risk higher than the market risk, because when the economy is not doing really well, people will cut down their consumptions on Apple products. So finally, our very famous CAPM model. That is the relationship between the risk and expected returns. So what is the expected return on the market? The expected return on the market, or you can think the expected return of the S&P 500, is going to be the risk-free asset return think about the T-bills, plus the market risk premium. In formula, the expected return on any individual security is going to be the return on individual security equals risk-free assets return, or the T-bill returns, plus the beta of that stock times the market risk premium. So all stocks return depends on beta and market risk premium. As you can see in this formula, risk-free risk return, market risk premium, those two numbers are the same numbers to all different stocks. The only variable that is different for each individual asset is beta I. So basically, what determines individual assets return purely depends on beta, which is the measure of the systematic risk of that individual stock. Okay, let's plug in some numbers. What if beta equals 0? Let's say what is that asset? If beta equals 0, the second term goes away. The return is just a risk-free asset. So T-bills, risk-free assets, has a beta of 0 because there is no risk. That is why they called risk-free asset. If beta equals 1, then beta goes away from this formula. The return becomes market return. So that is why market portfolio has a beta of 1. Then we're going to plot the return against the beta. Remember in our previous pictures, the horizontal line or the measure of the risk is the standard deviation. But now for the diversified portfolio, the horizontal line or the risk measure becomes beta, because beta measures the systematic risk only, while the standard deviation measures the total risk. The expected return, beta equals 1, the expected return will be the market portfolio's return. Here is a numeric example. If the risk-free asset return 3%, beta 1.5, what is the expected return for that individual asset? Plug in the numbers. That individual asset's return will be 3% risk-free assets plus 1.5 beta times the market risk premium, 10 minus 3, so 13.5% return. Okay, so let's see. Suppose you know the risk-free rate is 4% and you measure the market risk premium is 6%. Apple has a reported beta of 1.4. According to our CAPM model, what is the expected return for Apple? Well, plug in all the numbers, 4% risk-free assets plus 1.4 beta times the market risk premium, the whole thing here is 6%. The expected return for Apple is 12.4%. Okay, to emphasize the idea of total versus systematic risk, look at the following example. We have two securities, C and K. Standard deviation for stock C, 20%. Standard deviation for stock K, 30%. Beta of stock C, 1.25. Beta for stock K, 0.95. So which security has more total risk? Total risk means the standard deviation. Stock K has higher total risk. Which stock has more systematic risk? Beta measures the systematic risk. So stock C has a higher systematic risk because of the higher beta. So finally, which stock will have higher expected returns? Well, in a diversified market portfolio, the risk is only compensated, only the market risk is compensated by the returns. Firm-specific risk will not be compensated by any returns, which means stock C with higher beta, higher systematic risk will have higher return. So beta determines our return. Recall the CAPM model. When you plug in the numbers, higher beta will lead to higher expected stock return. Okay, so we have an example to calculate the portfolio beta here. Now suppose we have a portfolio consisting of the following 4 stocks. The stock's weight, individual beta. So what is the portfolio beta? The portfolio beta will be the weighted average beta of individual assets. So basically, the weight times beta of individual stocks. Then you sum them up. The total portfolio beta in this case is 1.947. Okay, here we have some multiple choice questions. What you want to do here is, again, you want to solve the question, pick the answers yourself. Pause the video here, and then check your answer. Again, calculating portfolio beta. But here I didn't give you the weight for each individual stocks. You have to calculate the weights, which is you calculate the total portfolio assets, which is 2 plus 3 plus 5, $10,000. So the weight for stock A will be 20%, 30%, 50%. And then you multiply each individual betas to calculate the portfolio beta. Pause the video here, solve the beta for the portfolio, and then check your answer. Market risk premium. So the market has expected rate of return 9.3%, T-bill rates 3.4%, inflation 3.1%. What is the market risk premium? The market risk premium is the market return minus the risk-free assets return. It has nothing to do with the inflation. Okay, so you pause the video here, solve the question, and then check. The next question is the CAPM model. Okay. Again, you pause the video here, plug in all the 3 numbers in our CAPM model formula, and then back out the beta. Pause the video, solve it, and then check. Alright, so that's the end of this chapter. If you have any questions, please email me.